Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets that shape our modern world. Today we're diving into an 8K filing from Burlington Northern Santa Fe LLC or BNSF. And let me tell you, this one has some interesting moving parts. We'll uncover how they're raising a hefty sum of cash and what that means for their future. Before we dive in, if you find value in getting straight answers from complex corporate documents, make sure you are subscribed so you don't miss out on future deconstructions. Also, for a more interactive experience and to connect with other finance enthusiasts, join our Discord community. The link is in the description below. Alright, so the big news here centers around BNSF raising close to $1 billion through an agreement to sell debentures, which are basically long-term loans. This happened around December of 2025. This type of filing, an 8K, is like a company's urgent announcement that something significant has happened. It is not a regular update like a quarterly filing, but a notification of important events that could affect investors. Now, BNSF is a pretty massive name in freight transportation in North America. They're known for their extensive rail network, and their financial health is pretty crucial for many industries that rely on them to move goods. The first item we see mentioned is about entering into a material definitive agreement. In plain English, this means they've signed a really important contract that is going to have a big impact on the company. And this is where the main story unfolds in other events. BNSF struck a deal, an underwriting agreement, on the 1st of December 2025 with some big players in finance like Citigroup Global Markets, Goldman Sachs, and JP Morgan Securities. These firms are acting as underwriters, which means they help sell the company's debt products to investors. So, what did they agree to sell? They're issuing a whopping $950 million worth of debentures. Think of these debentures as IOS BNSF is borrowing $950 million from investors. These particular debentures will pay a 5.550% interest rate, and they are due all the way out on the 15th of March 2056. That is a very long time, indicating a long-term financing strategy. This means they are essentially locking in this borrowing cost for over 30 years. These debentures are being issued under a set of agreements, including a main indenture from 1995, and a more recent 30th supplemental indenture dated the 5th of December 2025. The trustee, the Bank of New York Mellon Trust Company, NA, is overseeing this process, ensuring everything is done according to the rules. Essentially, they're setting up the framework to manage this big loan. Then we get to the exhibits. These are the actual documents that lay out the details of the deal. We see the underwriting agreement itself, the 30th supplemental indenture, and a certificate explaining the terms of these 5.550% debentures. There is also an opinion from a law firm, Cravath, Swain & Moore LLP, making sure that all this debt is legally sound and valid. The underwriting agreement is the core of the deal. It spells out precisely how the underwriters, those big financial firms, will buy these debentures from BNSF and then sell them to a wider pool of investors, like pension funds, mutual funds, and even individual investors who are looking for steady income. The 30th supplemental indenture is essentially an add-on to the original loan agreement. It details the specific terms for this new issuance of debentures, including interest rates, maturity dates, and any covenants or promises BNSF is making to the debenture holders. This certificate is like the official spec sheet for the debentures. It clearly defines the 5.550% interest rate and the 15th of March 2056 maturity date, confirming the details we discussed. So, what does this massive borrowing mean for BNSF? Well, raising nearly $1 billion can be for various strategic reasons. It could be to fund new infrastructure projects like expanding their rail lines or upgrading their equipment, which is essential for a company like BNSF to stay competitive. It could also be to refinance existing debt, possibly at a lower interest rate, or to simply bolster their cash reserves for future opportunities or potential economic downturns. The fact that they are issuing debt with such a long maturity suggests they have a clear long-term vision and are confident in their ability to generate enough revenue to service this debt for decades to come. From a financial perspective, issuing debt is a common way for large companies to fund growth and operations without diluting ownership stakes that shareholders have in the company through stock. However, it also means BNSF now has a significantly larger debt burden to manage. Investors will be watching closely to ensure they can meet these interest payments and eventually repay the principal. The 5.550% interest rate is not insignificant, and over $950 million, those interest payments will add up. Looking at BNSF's overall financial strategy, this move signals a reliance on debt financing for major capital expenditures. This is typical within the capital-intensive transportation sector. Their ability to secure this funding at a specified rate suggests they are viewed as a relatively stable and reliable borrower by the financial markets, especially given the long 30-plus year term. Now, looking at these numbers and what they mean more broadly, this filing tells us BNSF is making a long-term bet on their future. They are securing capital at a time when interest rates might be favorable for long-term borrowing, ensuring they have the funds for whatever strategic initiatives they have planned, whether it is expansion, modernization, or simply strengthening their balance sheet. The key question for investors will be how effectively they deploy this capital to generate returns that justify the cost of borrowing. The risks here are pretty straightforward. Economic slowdowns could impact freight volumes, making it harder to generate the revenue needed to cover these new debt obligations. Also, unforeseen operational issues or regulatory changes in the transportation sector could create challenges. However, BNSF's dominant position in the market provides a strong buffer against many of these risks. In conclusion, this 8K filing reveals BNSF is proactively securing substantial long-term financing. This is a strategic move aimed at supporting their future growth and infrastructure needs. While it increases their debt load, it also provides the financial muscle to execute their long-term vision. Alright, that is our breakdown of BNSF's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think raising this much debt is a smart move? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching. See you next time.